right. Welcome back. AVID Chat, David and Jack. Today we're going to be talking about a tool, actually. In the past we talk about matching your tools with your objectives. So we figured today maybe we just go through a tool, maybe something that you can add in your toolbox, something to use towards whatever objective you're trying to accomplish. And we figured today would be a good day to talk about something that tends to be underutilized. It's actually a pretty good tool to be using, and that is the health savings account, also known as an HSA. So that's what we're going to talk about today.
I think the way that, hello everybody, the way that you let in is perfect. I believe it's very underutilized. I think it's a term you probably have heard or maybe you've never heard at all about it. But we found over the years and really with our own personal experience, there's just so many good things that can come from having a health savings account, an HSA, that might be applicable to your situation. So this isn't specific advice. You have to use it. But it's definitely, hopefully we'll shed some light on some pros and cons and some things you maybe are not aware of. So I think we should just start with, let's kind of define this thing as what it is and where it comes from and how you get access to it as a starting point.
So it's a health savings account, an HSA. It is a savings vehicle that you can use in conjunction with a high deductible health plan. So you have to be using a high deductible health plan, depending on if your employer offers those or if you are purchasing it on your own. It would have to be HSA eligible. Normally, you can ask the provider if it's an HSA eligible plan, and they'll tell you yes or no. It's not always easy just to say, this has a high deductible, it's eligible, because sometimes they have higher deductibles and they're not. And sometimes what seems like is a lower deductible does qualify to use an HSA. So it's used in conjunction with a high deductible health saving or a health insurance plan is what it's used with.
And to just clarify the deductible, that's basically the out-of-pocket that you have to pay if you were to say, let's go to a hospital, if your family needed some sort of care. So a lot of providers have ranges to the benefit and the deductible, which those things then go to how much premium do I pay. So This HSA, as Jack's saying, typically comes with almost always a higher than normal deductible.
Which is something to keep in mind. So I think the first thing would be is, how much am I using my health insurance in a given year? If I'm somebody who is going to the doctor frequently, or I have some kind of chronic condition where I'm always getting treatment, using a high deductible health insurance plan might not be the thing to do because you're going to be paying out of pocket pretty frequently. If you are a healthier person where you're just not going to the doctor that often, maybe you're going for preventative stuff, then you might want to look into a higher deductible. And a higher deductible can be $3,000, it can be $6,000. You got to keep in mind there's a deductible and then there's an out-of-pocket max. So sometimes your deductible can be $5,000 and your out-of-pocket max can be $8,000. Looks like I have a visitor.
Awesome.
Let me get the dog.
Libby?
Yeah.
Did you say health savings account and medical expenses?
All right.
Yeah, so that's right. The out-of-pocket maximum and the deductible might be different. This is all things that you need to know and understand before you just say, okay, let's start doing an HSA. So let's assume that we have gone through, or we've even used an insurance professional to help go through the plan and see what your options are, and it deems that you're a good fit. And I think one strong point to that is you're not frequently going to the doctors, a hospital, whether that's individually or your family. You just have a good history of health. Therefore, you're currently paying insurance premiums, but you're not really getting any benefit for that premium that you never see it. It's like auto insurance, really. How many accidents do you get in? So let's make that assumption, if it's okay, that you qualify and have access to an HSA. Now, what are some of the technical benefits to this thing?
Well, a couple of things. One is, if you use a high deductible plan, typically if you're doing somewhat of an apples to apples, so you're using a high deductible plan instead of something that has a lower deductible, usually the higher deductible plan will have a lower premium monthly. So just to kind of pull some numbers out of it, let's say the higher premium is $350 a month, the higher deductible is $200 a month. So low deductibles, $350, higher deductibles, let's call it $200. It really depends on the provider. That may not be exact, but let's say there's a $150 difference between the two. If you are, like Dave said, somebody who's just not going that frequently to the doctor, if anything, you're just doing preventative stuff, and you use the higher deductible, that extra, let's call it $150 in money that you're shelling out, you're really not getting any benefit from. So the first thing that you could do is you could say, well, I have $150 that I otherwise would be spending on health insurance. Where can I put that? If you open an HSA with your high deductible plan, you can put that money into a health savings account. If you're familiar with like an IRA or something like that, it works similarly. It actually has additional benefits, but you can put that $150, let's say, into a health savings account. And then as the year goes on, if you have qualified medical expenses, you can take the money out of the HSA and use it to pay that. And then the money that goes in is tax deductible. While it's in there, it grows tax deferred. And when you take it out, as long as you spend it on qualified medical expenses, it's tax free. So it's basically what you could call triple tax free. Tax deductible, tax deferred, and tax free as long as you use it on qualified medical expenses.
So I don't pay taxes, income taxes on the money because It doesn't come to me. It goes into the account. Mm-hmm. It's not taxed every year as though it were in like your savings account and earning interest, which we can talk about what it earns in a minute. And then, like you said, if you spend it on qualifying health expense, there's no tax. I mean, it almost sounds like this is a perfect account. Why do people not use it more?
Yeah. I mean, yeah, right. It's really awesome. And really all you're doing is you're taking that $150 that you otherwise would be spending on medical expenses anyways, and you're just setting it aside. A lot of times also when you have a high deductible plan, it still includes preventative stuff. So a lot of times you'll think, well, if I'm going to go to the doctor once or twice for a preventative, a lot of times it's included and you don't have to pay that. The other thing is if you have health insurance and you do go to the doctor, you still get their negotiated rate. So it's not like you go into the doctor and pay the cash price. You'll pay whatever you would pay as if the insurance company was paying it. So you still get the negotiated rate. So all around, it's pretty good in terms of savings.
What
now,
about,
there's a few, go ahead.
You're going to say limitations?
There are some limitations. There's really not much. I guess a lot of it would be your specific situation. You have to put the money in there, number one. If you get a high deductible plan and you're not somewhat setting aside the money in case you have to pay some medical expenses, well, then you're just going to end up, putting it on a credit card or something like that, which you don't want to do. So you want to make sure that you have the cash flow. And if you do have the cash flow, make sure that you're actually putting it into an HSA. The drawbacks would be something like, you can't, if you do take the money out and you don't use it on qualified medical expenses, you use it for something else. I mean, you have to pay tax on it. You have to pay a 20% penalty. So it's not something that you want to be using for other types of expenses.
Is that 20%? Is that forever?
It's not forever. So if you end up, you can kind of use it as a retirement plan when you get to retirement age. It really depends on, the person that's, I guess, watching this. If you're 55 and you're closer to retirement and you start plugging it away, you can use it for retirement. There's no penalty. Once you get to retirement age, you have to pay tax on it. You don't get the tax benefit, but you can spend it on other expenses just like you would any other type of retirement account. It has the additional benefit is that you can use it to pay some long-term care premiums if you end up getting long-term care. You can use it to pay Medicare premiums when you get to that age. So it has a lot of flexibility as well as far as like what's a qualified medical expense, especially when you get to be a little bit older, as far as what you can use it on. If you're a younger person, it's hard to really think, 35 years from now, I'll be using this money for, retirement. But it does have the added benefit is it does grow. I mean, usually what we would suggest is if you have the cash flow, of course, is try to fund it to your out-of-pocket max, whatever that may be. It's $8,000 or something. It depends on your plan. If you can fund it up to the out-of-pocket max, which we're going to talk about funding limits in a minute, that can be in cash. And then anything above that, depending on your HSA provider. So there's lots of places that offer HSAs, Fidelity, there's all kinds of places that offer HSAs. They'll also offer investment options, just like you would in a retirement account. So you could have your out-of-pocket max in cash, let's say, just in case you ever needed to use it. But anything above that, you can invest like you would any other investment account. There are limitations to how much money you can put in. I think it's $3,200. I think it's $3,200 in 2021 for an individual.
36.
What's that? 36?
Yeah, 36 individuals, 72 as a joint
family.
pilot.
Right.
Yeah.
And there are catch-up contributions after, I think it's 55. Yeah.
After 55, it's $1,000. So if you're 55 years old and filed jointly, you could essentially put in $8,200 per calendar year into the HSA. And I think, and keep in mind, this is not an FSA, which you might have also heard of, right? Which is a flexible savings account, which has the use it or lose it feature to it on a flexible spending account. So the HSA doesn't have to be spent every year. So it literally can become a savings account and build up over time, especially if you're not going to the hospital, you're not getting prescriptions, you're not doing a bunch of crazy things. It can build up quite nicely.
Right. There's also there's lots of techniques of things you can use. You may see places where they'll say, if you have an HSA, you can pay your medical expenses out of pocket, leave the money in the HSA. Obviously, you don't get a tax benefit for doing that. If you do that for 10 years and then 10 years later, you've kept your receipts for all of your non-reimbursed expenses, you can reimburse yourself all at once. I'm not a big fan of that because that's one of those things where you're kind of betting on the rules being the same 10 years from now. You can make the argument either way to go ahead and use it when you have medical expenses or not use it, just leave it in the account to save up for later. I tend to be of the mind to use it for your medical expenses as they happen. I mean, there's no, as far as if leaving the money in there, I suppose, but I'm more of the mind that if you have medical expenses, use the thing to pay your medical expenses. You could make the mathematical argument that if you leave it in there, it grows to be more and that kind of thing. But I don't know that using after-tax money to pay medical expenses today versus getting it tax-free, which depending on your tax bracket might be more beneficial. If you have a $500 bill and you're in a 28, 35, whatever, 37% tax bracket, it's like saving 30% or whatever, 35% on the bill. That's quite a bit of money extra that you're paying that you otherwise wouldn't have to pay. So,
right.
Anyways, I wouldn't worry about that. That's a little bit too, I just think you're trying to squeeze too much out of it. But as far as maxing it out, I think it's good. So I think maybe we should just do like I think we should do 2 use cases. So I think maybe we'll do a use case for like let's call it middle-aged couple to put money in. And then we should also talk about for business owners, because I think we've talked about that. It's beneficial for business owners to offer it either to themselves or to employees. I think they can be beneficial. So I can, I don't know if you want to take up the business one, I'll take up the.
Yeah, I'm just thinking of like the middle age. I don't know if, am I middle age? 44?
I think so.
55? Crap, man. I guess I am. So then let's just pick on me. So Melissa and I, my wife and I have 2 kids. Everybody knows that. If this isn't your first AVID Chat, we started doing the HSA maybe 2 years ago. And I think the first hesitation was, man, that out-of-pocket deductible, if the kids like break a leg or have to go to the ER or something, I mean, that could really be detrimental if there's not additional cash set aside, which I would say the majority of families probably don't have that. So it was a little, I think, nerve-wracking to get into that mindset. Now that we've been in it and there's building, and really through 2020, which I guess another highlight of 2020 is we were never at the doctor, probably because the kids weren't in school and they weren't getting stuff and we weren't going anywhere. So we essentially have, put money into there and reaped the tax savings of that contribution, and we'll now have a little bit extra time to get to that deductible thing. So I would say from our situation, if you're listening and similar, it might be a difficult first step or first year or two to do it. And that's where really the planning side of it comes into play.
Right. Yeah. That first year or two, when you're like, well, if something happens and we have a $6,000 bill and we're going to have to pay it, that's always the hurdle. I think once you get past that, it's a little bit easier, but you're right. I mean, you have to get to the point. You could make the argument, I guess, depending on your situation, that if you do have the cash in something else, obviously if you have it in some kind of taxable account, or you have it, maybe you take some of that and go ahead and throw it in there just to give yourself a little bit of a cushion. But regardless, it is a little bit nerve-wracking when the deductible's that high. Right. First couple of years.
So now I'm a business owner. I am a business owner. You're a business owner. So as a business owner, why would offering an insurance plan with a high deductible be beneficial?
The first thing is, obviously, it's less expensive. Typically, a high deductible plan is going to be less expensive than something with obviously a much lower deductible, typically. You can offer multiple plans if you're a business owner, typically. So you can offer it as in conjunction with a lower deductible. So you can give people choices. You can say, this is a high deductible, this is a low deductible. You'd be on the hook to pay the portion of the lower of the two. So it might actually save you a little bit of money. But the benefit is, one, if you can educate the people that work for you. Obviously, this depends on your makeup of your employees and how many you have. And, if you work in a business where you have a lot of young people that aren't going to the doctor a whole lot, but they want to have some health insurance, it's, it'd be beneficial to at least educate them on, here's something that you can use and how you can use it. But in addition to that, they can use it, and you can use HSA contributions from the company as an additional benefit. And it's super easy to do. There's no real setup required other than what you're going to do anyways, getting your health insurance set up. So if you get your health insurance set up and they have an HSA eligible plan, there's typically going to be an HSA, but they could use whatever they want. They can use the one that comes with the plan, or they can use an outside one. There's no real requirement. And then you can say, well, if you put in $500 to your HSA, I'll match the $500. Or if you commit to $100 a month to your HSA, I'll go ahead and put $1,200 in right now, as long as you commit to $100 a month for the next year, let's say. So there's lots of things that you can incentivize them to put money into their HSA. That's their money, of course. But you can match it, because it ends up being that money that you, the company anyways, are putting into the employee's HSA is payroll tax free. It's all pre-payroll tax. You're not paying payroll taxes on it. They're not paying payroll taxes on it. They're not paying income taxes on it. It goes right into their dollar for dollar, whatever you want to match. It tends to be a pretty good benefit for everybody, assuming that your employee understands what it is that they're getting. If they just think you're just throwing money into an account that they can't get access to, or something they're not going to use, they might be hesitant to do it. But if you can educate them that this is a health savings account, and chances are, you're going to go to the dentist, like you can use it for your dentist visit. You can use it, whatever. If you get some stitches or something, it's a great benefit, and it's super easy to set up. It doesn't cost really any money at all outside of what you would be paying to put the money in there and what you would be paying for the health insurance plan. It's a great benefit. I wish more people would use it and give it as an option. So,
well, I think part of it is the education part. The business owner probably isn't educated on it. I don't think it's a widely sold part of the normal insurance plan. But then, like you said, if I'm the employee and I don't understand the benefit, I'm going to say, well, I don't want to put money into a health account.
Yes.
Because I'm healthy. And depending on what they're getting paid, and how tight their own cash flow is, they might not have the money to do it. So the proper education and the explanation of how this thing works and how it could benefit, a young 25, 35, 40-year-old person, maybe that's single and just whatever, is really fantastic. So education is, I agree, 100%.
Yeah, and also if you're an employee of a bigger company, I would consider it. I know, I'm pretty sure Mel's the same way, but just because previous employer used to offer, they offered multiple health insurance plans, but the one that they offered that was an HSA eligible plan, one, it was less expensive. for us. We don't go to the doctor frequently, just doing checkup stuff. We are just not there that often. But they also made a $1,200 contribution to your HSA. They just did $600 in January, $600 in July, but that was like they just put it in your HSA. So it was less for us premium wise, and they gave us an extra $1,200. It's a big savings, and it's a huge benefit to do that. So if you're an employee of a bigger company too, if you're watching this, I would really consider a high deductible plan, assuming that you're just not going to the doctor that often.
No doubt. As you said, I'm thinking because Melissa's enrollment will be coming up, and the way her company works is actually they pretty much give a flat figure to every employee, and every employee then is free to choose the plan. So, and I don't remember this, but let's say that whatever they give the employee covers like the top of the line plan, and then the HSA high deductible plan is $400 less per month. The company would essentially pay her out that $400 a month in income. So what we're doing is just taking that and putting it into HSA. So it's really, they're making a huge contribution and we're not paying income tax on it, and we're getting the savings from it. So agreed. Looking at your employer benefits and plans, and if we can help, we know enough to be dangerous. If we need to get an insurance specialist involved, we can do that too, but could be highly valuable.
Yeah, for sure. You get to keep it, you can invest it, you can use it for retirement, it's triple tax free. It's a really good planning tool to use depending on your situation, and it tends to be underutilized. So it was definitely something I would look into.
I think that was great. Good AVID Chat, another tool in the toolbox. Hope you've enjoyed it, and we look forward to seeing you again next week.